All right, Money Miners, I've got a special chat that I'm excited to do. I'm here with the founders of Baza Capital, Brayden and Will. Thanks for joining me, guys.
G'day, JD. Big fan of the pod, so great to be here.
Appreciate it. We've got heaps to talk about. I was pretty excited reading up on your fund's history, so I kind of want to start there. And I want to start with you guys starting the fund January-ish of 2020 and just getting absolutely smashed in the first few months. What was that kind of like? Talk me through it.
Yeah, I mean, we'd been moonlighting for a while, so we'd got the fund set up and the business set up. But yes, we did indeed push the boat out in January 2020, and that was in our Baza High Conviction Emerging Companies Fund. So right on the avant-garde with respect to small caps and, risk being off for a very sharp period and a very sharp decline. But happy to say that we hadn't fully kind of put our cash to work at that point in time, and we'd done a lot of work on the companies that we'd put into, and so we didn't need to make too many changes to the portfolio, even though it was a pretty stark start to the fund. And then of course you see what happened, the V-shaped recovery, and it turned out to be a great time to start a fund. Honestly, 2020, 2021, great period of outperformance for us and small caps and junior mining, which are the things that we focus on. So we're probably pretty lucky in the end.
So how long did it kind of take to get fully invested in that fund? You sort of get the cash on the door. I'd imagine there's a lot of fundraising that goes on in the kind of year prior, and then you ended up having a bit of cash balance just sort of reading through those monthly reports. Worked out well in hindsight, I guess.
Yeah, it was. I think rolling back to that January, the market was relatively toppy, I think was the feel. And then when we started deploying, it did take a lot of time. I'd say we were probably 3/4 of the way through when the initial reports of what was this, emerging pandemic coming from China and overseas. So, we had, I think Will painted a pretty rosy picture of that initial days. There were certainly some very dark times, but...
A couple sleepless nights.
Many.
No doubt, yeah.
I think there was, genuine excitement with starting something.
Yeah.
And then that, goes in lots of different emotions in that first few months. But I think the story of 2020 and then large part of 2021 was one of genuine excitement, because there was a lot of, opportunities to deploy money. Obviously a lot of capital raisings from that, April, May, June period throughout 2020. So it was quite exciting. I think the one investment that probably marked almost the bottom of the market, or certainly from our fund, was that Chalice initial hit, which was probably towards the end of March 23. And
had you owned Chalice before, or did you own it in there? Or was that just something that stood out at the time?
But very quickly then we did. Yeah.
Awesome. Would have worked out quite well.
It did, yeah. I think Chalice was one of the better performers for us in 2020. Certainly it's been a good holding for the fund at various points. We still have a small holding in the fund at the moment with Chalice, and I think that broadened pretty quickly. At the time we were towards the, higher end of the metals and mining exposure. Just to clarify, it's a generalist fund. So at the moment we probably would have 80% of the investment sitting in industrials, healthcare, IT services, and circa 20% within the mining space at the moment. In 2020, I think it got up to a high of about 40%, largely through price appreciation, but also the opportunity set.
So you looked at a good few goldies at the time as well as sort of having that cash buffer. So the portfolio was pretty stocked up. Was that weighted to your producers? Did you sort of mix it, or stay where the area you kind of know a bit better, those developers and that end of town?
It was towards that end of town, and clearly gold had a good time of it in 2020. But I mean, we try not to be too macro, or particularly not make tactical decisions around macro. And so Brayden and I are out of mining finance for the majority of our career, and so gold companies, analysing them, doing due diligence on them, the personalities there, our network, which can kind of enrich that due diligence. it was just a comfortable place for us to start our investment. And so, probably a bit of luck that ended up being a great place to be investing at the time. But yeah, we certainly added to it as that, gold environment was clearly opening up for us.
And then sort of just zooming out on the history coming through 2021, that was a hell of a year, especially in the sort of area you guys like to play. I mean, for most sort of sectors, but what was that part of the roller coaster? Kind of like flat out every day, a bit more exciting, relaxing in a way, or is it sort of different?
Yeah. I mean, it was great to start with that initial pretty difficult market, because you're haunted by that and it sticks with you, and it gives you a discipline that you're going to take through your career with you. And actually, in my career before this, I started in the year of the GFC, so I had a very, very similar kind of baptism by fire. Yeah, you really do need to keep your head. There's plenty of... Everything has a different, more positive complexion when, things are going up and to the right. And so we just needed to really make sure that we were still investing on fundamentals. We weren't grabbing at every piece of candy in the store. And we're really happy with the portfolio we put together at that time. Took good advantage of the bull market, but have been able to still, have good returns.
Speaking of candy, have a look at this piece of eye candy. Paul Natoli from Grounded. What a good-looking rooster, as I've alluded to before. And, mate, the precursor to the eye candy that is a grounded village in construction.
That's
Check
candy.
This out.
Wow.
I'm seeing bloody diggers with grounded on them. I'm seeing bloody grounded signs everywhere, grounded utes, grounded gear. That is a full turnkey construction solution for the mining industry.
What a point,
JC
mate.
and Trav. Far out.
Those camps look divine.
Divine, mate.
Like
Anything
candy.
that sits above the ground on a bloody mine site, grounded, can build it.
All your non-process infrastructure.
Yeah.
Just get onto them.
Mate, and the best thing is they're bringing the building standards from the greatest country in the world to Australia, the motherland, Sicily. Mate, unfortunately, looking at that photo before, mate, Paul Natoli is married, so the closest thing you can get to Paul himself is a grounded camp. So
Get yourself sorted.
So why don't we talk a bit about the fund, the initial fund that was set up, the Baza High Conviction. How many companies do you like to hold? What are your sort of classical holding periods, if you like, and all these kind of broader details to start?
Yeah, we'll go through the 101. So Baza High Conviction, that initial fund that we launched in the start of 2020, it's a traditional long-only emerging companies fund, only invested in the ASX as well. There are probably three key differentiators to other traditional small-cap funds. The first being we take a relatively concentrated portfolio. Our top 10 holdings would probably comprise close to 70-80% of total FUM. I think the total portfolio is between 25 to 30 at the moment. That's largely due to our approach of the mining tail running a commodity bucket as opposed to an individual industrial business.
Has it been refined, or was it always from the go that many sort of companies that was the way you guys wanted to go about it?
It's probably shrunk over time.
Yeah.
We are an emerging fund manager. We always are quite introspective and wanting to, I guess, improve and reflect what we have been doing. And I think some analysis that we ran close to 18 months ago, it was quite obvious that the largest holdings were disproportionately better contributors to alpha, meaning that even accounting for their weighting, they were generating larger returns for unit holders than a tail that we were maintaining, and it wasn't. We weren't holding 100 companies. We may have, instead of been holding 25 to 30, we could have been holding 40 to 50. And so a lot of that centres around the reason for being more concentrated, having high conviction in a name, and really just keenness to keep things simple was the overriding factor. And we looked at each other and said, let's just build a portfolio of really the core ideas. And for that, there wasn't too much changing within the portfolio. A lot of it was just naturally letting those larger businesses appreciate and probably taking a more harsh view to the long tail that we were maintaining.
That's really interesting what you say about the the return sort of being driven by those best picks. Do you put that down to putting more work, having more conviction? Is that a market structure type thing where these guys go into the ETFs, they attract more capital, more generalist funds look at them? What does it kind of come down to, the fact that a lot of these sort of markets or subsets of markets end up accruing to one sort of powerful name?
Yeah, I think it's not so much the size of the company, it's more the size of our holdings. So actually one of our best returners ever was only a kind of a $40-50 million market cap IT services company that ended up getting taken over, and that ended up being a fantastic win for us last year. But it's more so that I think, it may even sound obvious, but we have the conviction to make these our largest holdings, and there are reasons for that. It is the amount of work we've done, but it is clearly the amount of attractiveness there is there. And then these stocks that were more sitting around the maybe 1%, 2%, 3% of the portfolio, clearly we've got the foot in both camp because we're not comfortable to put it 5% plus. And so it really makes sense, I guess, that what we found was the ones where we did have that confidence were the ones that returned best. So why not just cut out the ones that we didn't have the conviction on?
Yeah, I'm keen to hear how you find these names, how you screen for these names, and I think we should talk about the responsible investing or the mandate that you guys operate with to kind of start with. And I think one of the questions to ask off the bat is it kind of misunderstood? The reputation of this style of investing has changed quite a bit over the guys that you the period that you guys have been in kind of operation. So how do you think about responsible investing as a broader sort of sector or thematic at the moment?
Yeah, I guess we don't think of it as a sector or a thematic. We think of it as, a philosophy for investment, and probably wouldn't say it's misunderstood. I think it probably just means different things to different people. And for us, it's always been really important that we invest in line with, our values and where we see the future heading. And so it's no surprise that electrification and decarbonisation is a big theme of what we do, both in terms of what we don't invest in, but also in what we do invest in. And then as an adjunct to that, and what's really important, particularly on this podcast, is metals are such a big part of that. And so while we're responsible investment, there wouldn't be many out there who are responsible investors who are as comfortable as us to invest in mining stocks, and particularly those that are tied to electrification. So it was really important to us to be able to kind of bridge what's seen as, kind of these two different sets of investors. One that's, happy to invest in anything, just give me the risk return. And then the others who are more, I want to invest in what's good for the world. I mean, we kind of see it as, why can't we do both? And so we invest with risk return as our first and foremost, and as the North Star, as it should be for a fund manager. We do cut out things and we do scale up our investments in some positive industries, but our opportunity set operating in the ASX listed small cap space is such that we can still invest in about 1,000, 1,200 companies. And so we really don't feel like we're being stifled by the things that we're cutting out. And so, we just see it as a really positive way for us to invest. We also, and this is important, I think, because of the way we structure our responsible investment framework, we tend towards industries with long-term tailwinds, and that is circular being good investment in our view anyhow, and leading to good risk returns. So I probably hopefully that gives you a bit of an insight into it. Maybe Brayden had anything to add.
Yeah, I mean, just in practice, maybe Brayden, what that kind of looks like, because you've spoken about there's no shortage of companies. At 1,200 is a lot to kind of choose from, but setting up the fund like this, I'd imagine there's a mandate, and that sort of plays into perhaps how you screen for companies to maybe on a sort of day-to-day kind of basis. I'd love to learn what that actually means for how you pick out opportunities.
Mm-hmm. And maybe just to dig a bit deeper into responsible investment, I think some of the confusion, if there is, I think a lot of, perhaps your listeners and others would have a good understanding of, what is the core of responsible investment or ESG. But the confusion may be around with how different funds, and there are lots of different methodologies, and how that's actually then applied, because everyone has quite different processes. We'll go through ours.
Yeah,
There will be different processes, and people will apply it in different ways with different negative screens. Some funds will use the United Nations Sustainable Development Goals, UN SDGs. Some funds will track carbon intensity and have that as a key metric. There just hasn't been something that centralises a lot of responsible investment reporting, and that's unfortunately where some of the confusion lies. There's no JORC code at the moment, so clearly setting out what's measured, what's indicated, etc. That just hasn't come to the industry as yet. We're clearly hoping it does, because it'd be great to then have everyone reporting, and then allow, whether it's prospective investors or particularly companies that we meet with, have a great idea about what's is actually applied. So coming back to Baza Capital and the Baza High Conviction Fund.
Just before you get into, just to keep going on the responsible investment, because I think it is important, but I mean, that's why what we value most in our business is transparency. So people can see on our website, in our information memorandum, on the back of our monthlies, what we do and don't invest in. And so the unit holder makes their choice about whether that's something that they're comfortable with as well. I mean, I think maybe people start to have an issue with it when they feel it's been forced on them, or is, lacks transparency, and it's like someone's trying to force their values onto them. So we would have a unit holder set that some are very focused on the responsible investment side of the business, and probably maybe gravitated towards us because of that, and then some that were probably a bit more ambivalent towards it, and are just there because they enjoy the risk return, hopefully. But yeah, to get into actually how we build the portfolio.
So it comes on at the outset. So as we define our universe, we'll use what's called negative screens within the industry. So they're typically on a sector, like gambling, tobacco, are common negative screens. And so you'll run through in our mandate the ASX listed universe, and then we'll screen out, these are the companies that would have primary operations that relate to gambling or tobacco. And there's some common negative screens that you'll run through, and we list ours all on our reporting website, keeping it as transparent as we can. And so that then reduces our investment universe. And then as we progress through the investment process, which is typically then risk and return driven, engaging with management teams, going through financial reports, the notes, collecting, information, building our financial models. As we meet with the companies, often we're then also asking questions around what's your strategy for, introducing renewable energy to your project. Do you have a strategy? If not, sometimes there's an opportunity for us then to introduce to, perhaps it's a consultant that can help provide some initial feedback, and that's something that we're really helpful to do. But ultimately, the management teams and the businesses obviously are making their own decisions, and there's hundreds or thousands of other shareholders that have their say in the business and how it operates.
So I'm keen to learn a bit more about how the two of you kind of work together, and then how that kind of feeds into actually picking the companies that you ultimately invest in. Do you find, do you, for instance, need full agreements on each name that goes into the portfolio? Do you let one take the lead on a name if they've done a bit more work? What's that sort of working relationship like?
Yeah, I think I can start by saying I highly recommend, if anyone's going to start their own fund, that they do it with two people, because, particularly in those early days, we were able to, kind of take a lot of confidence from the discussions that we'll be able to have with each other. And, when one person was emotional one day, the other person could, pick up the ball and vice versa. But as it relates to Brayden and I, we've actually worked together in two other places before this. So the investment bank UBS, and then a boutique advisory called Vysarn Capital. So before we started Baza, we had a really good idea for how we work together. And I think over the years, and it's many years we've worked together now, we've probably built somewhat of a fraternal bond, which is allows us to really have quite robust discussions and really, kind of, one person comes up with this idea, not just glad hand it and let's go. It's really why and who where'd that idea come from? What's the analysis you've done? I don't agree with that aspect, that type of thing. So that's been really positive for us, and I think we can we've always able to dust ourselves off after one of those robust discussions and just get on with it as well. So we kind of have that real understanding. In terms of our individual attributes, I mean, Brayden is just an absolute efficiency machine, just crunches through data, screening, analysis. And so that really helps us to take that huge opportunity set down to a smaller opportunity set. And probably where I come into it and we kind of meet in the middle is I'm very OCD. I'm very focused on our processes and our risk management, and really keen for us to make optimal decisions. And so putting those together, we probably meet in where we're making the actual investment decisions.
I think what's interesting, JD, and something that we certainly learned a lot has been the psychological aspects of investing can at times be the most valuable, or at least could be on the other side the most detrimental. And so what we do with each other as well is get to understand someone's taken a stock through from initial screening through to investment. They're very confident, perhaps too much for, they have this, I've done so much work in this. We need to step in and then, check each other's biases, as well as sometimes someone can be too negative on a story. It just helps to have that second brain personality, call it, that will be in a different head state as you in any given day to then just check. And essentially the best thing is to be as, not dispassionate, but just to be as level-headed when you're making decisions, and just having the two of us working together has helped us, or at least that's really what we strive to do.
Do you find one of you's more cynical?
I think we can be equally cynical, and I think that's what helps. Yeah, so it'll
We're pretty
usually
optimistic people.
Oh yes,
So, I think you have to
we're
be
glass
to be.
half full in general, but I think when it comes to, we do play the good cop, bad cop, because I think it helps to have the person who's got the exuberance about a particular story, probably because they've done more work on it and maybe fallen in love with it to some extent. To have the person really challenge that on the other side, I think is highly valuable. And so, I think we can both play that role in.
Yeah. But this obviously doesn't have to occur with, going out and joining investing accounts and going out and doing everything with a partner side by side. I think just having a discussion with someone who's either very cold or new to an idea, it could be anything. You could be looking at, a new gold company that you've picked up, and then to have a cross-check with someone new, and you take them through essentially, poke holes in my investment thesis. It could be one of your friends. It could be, a broker that you really respect. That's incredibly valuable. I think one of the key learnings for me personally has been the real value of some of the, probably more the softer qualitative pieces of analysis or skills or assessment. I think when we came into funds management, our backgrounds were quite analytical, like coming from investment banking and really focusing on, okay, what's the numbers, what's the modelling. That has been called the bread and butter, but we feel most comfortable sitting in the notes of an annual report and unpicking some of those insights and building a financial model. But really value comes from asking someone that's either in the industry and is working at a competitor, or I actually studied civil engineering at uni 15 years ago, and we were looking at an engineering consultancy business, and a lot of my peers and friends still are in the industry to be able to pick up the phone and just ask some of those softer questions. How hard has it been to hire people? What do you think of this competitor? Well, have you come across them on other transactions or other bids? This is the softer skills. Sometimes you find that a conversation with a research analyst may throw up a fatal flaw in your analysis and saved you 15, 20 hours of work. So some of the softer side of talking to either friends or ex-colleagues has been incredibly important. And I think from our initial approach, which focused around analysis, to then build that in, we're probably finding we do more of that as we progress.
So going deeper on those sort of softer skills you talk about, do you find meeting management has become an absolute staple, or are there cases where you can sort of learn enough from the paper, from interviews, or these sorts of things beforehand?
That would be one of our rules, effectively. Have to meet management. And given we're in small caps, even though we're a relatively small fund at this point in time, our access is really good. So we, in general, will be able to meet anyone that we wish to in terms of companies that we would like to invest in, and we'll often do that multiple times before making investment, and then once we're invested, regular catch-ups.
One more on just sort of starting the fund. Who needed the final push to maybe leave a job or get over the line, or was it an idea that had been scheming for quite some time?
I reckon Brayden came up with the idea. I remember the cafe we were sitting in when he approached me on it. So probably me, but I don't think I needed too much encouragement. I think I talked to my wife about it that weekend, and she knew I didn't love my previous job. She said, go for it. I think she had a lot of respect for Brayden and what we might be able to achieve. So I think once we decided to go for it, it just was pretty one directional. Yeah.
Awesome. That's some great support too.
Yeah.
Let's talk about some mining related businesses. So we were chatting prior to this, and we thought we'd go about it a different way. Obviously, we love to talk about mining companies, but there's a whole sort of subset of companies out there that can, ride the same sort of wave, if you like, of a commodity cycle or various commodities and their respective cycles. So maybe it's a sort of picks and shovel way, but as a broader sort of space, whether it be sort of mining services and all these sort of other companies that we're going to chat about, they have been pretty unloved for quite some time from my perspective. Is that something you guys would agree with?
Unloved from the perspective of perhaps trade at lower valuation. Is that what you're getting at?
Yeah.
Yeah, I mean, I think a lot of that comes to what's the market's appetite for cyclical risk and, divergent views on the commodity outlook, divergent views on where we are at which point in the economic cycle are we at the moment. But in terms of just general, we look at mining services, probably stretch it a little and say, what are the businesses and companies that stand to benefit from, we're pretty constructive on that mid to long-term outlook for commodities, whether it's tied through to those commodities needed for electrification or through to, a growth in emerging markets and all the commodities that will be consumed as, global GDP or GDP per capita increases. So for us, what are the businesses that stand to generate? And it isn't just businesses that have, the capability around drill and blast, although they're, fantastically leveraged to that thematic. But we look at, companies that in the WA economy, I think if you're bullish on the outlook for commodities, you probably are then going to be pretty bullish on the outlook for the WA economy, which is already, the jewel within the Australian crown at the moment. And we say that coming from Melbourne right here. But essentially, Euroz Hartleys is a good example of a business that we've invested in. A fantastic balance sheet was really the key draw card for us. But we believe that will be a business that throughout the cycle will have its moments, and we think that if you are constructive 5 to 10 year outlook, it may not happen in the next 6 months. It'd be great if it did, but that's a great business that's really set up to weather if there is, weather the storm if there is continued softness in the particularly junior mining space. But they've got great leverage to a recovery in mining capital raising volumes, the general wealth of WA increasing. They've got fantastic, private client advisors, wealth advisors that we've worked with over the years as well. So that's an example of a company that you wouldn't necessarily think is it directly related to, mining services, but mining adjacent businesses is how within our fund we'll also take that thematic and invest in not just the upstream mineral producers, but then have a broader set of industrials or financials that are tied to that mining growth.
That's such a fascinating way of playing the resources space. How do you think about valuing a name like this? Like you mentioned, heaps of cash on the balance sheet. I'd imagine it's the type of company that would just have a very high payout ratio when it comes to it. But in a time like this, how do you get there from a valuation perspective?
Yeah, there's some great ways to look at it. It's multifaceted, but just what drew us to it, and Brayden somewhat mentioned this, is currently 135 mil market cap with $92 million of cash investments. So you've got this really strong capital support to your entry price, and so that gives you a lot of de-risking. Then you look at their history, and in the 20 or so years that Euroz has been listed, they've paid $345 million of dividends and $40 million of capital returns on top of that. So that's almost triple the market cap that you're currently looking at. So it does show that they've had a strong propensity to pay out previously. And they quite recently did a major payout to shareholders when they actually divested their funds management business. So then you look at, okay, well, what kind of profitability metrics can these guys do, noting that it's highly cyclical. You look at their history, and in the really tough times, they are generally able to stay break even, maybe small losses here or there, or small profitability. But then what you look at is in the good times, so 2021 probably being the most recent example of that, they had a net profit of over $50 million. So at the top of the cycle, you're buying something that could be on a 3 times PE, as well as all that capital backing, as well as all the tailwinds that we believe they have through this multi-decade boom ahead in metals, and the strength of the WA economy. And then on top of that, you've got this strategic aspect of it. So we actually think Euroz Hartleys would be a fantastic entry to the WA market for either a larger East Coast competitor or even potentially an international organisation, even believing that WA has some attributes that lend itself to a really strong kind of location for wealth management. The amount of billionaires, I think there's more 100 millionaires per capita in WA than anywhere else on earth, and so you've got this real kind of Switzerland, Norway potential even as well.
Yeah, I think I saw Pepe Grove in 2021 too.
Yeah.
It was the highest earning suburb or postcode in Australia, fighting out the likes of Melbourne and Sydney there.
Yeah, there you go. And we've operated with them for a long time, both through Baza and in previous careers. There is a market quality to Euroz Hartleys. They've got a lot of great personnel. They're growing their business. They've got this new graduate program, which is kind of cultivating new talent. And they've got a bit more of a focus on this more wealth management side of the business, which is $4 billion under management, which is another way that you could value them and have a look at it from that perspective. And that is a truly large amount of FUM in the context of the WA market.
People don't generally think of brokers as not looking after themselves, to kind of put it bluntly. Do you think there is enough inside ownership in the business that shareholders are the ones that get rewarded when times are good?
That's the thing that gives us comfort, is it is really highly owned by the key decision makers, as well as Hartleys got purchased through Euroz Scrip, and so there's a lot of the Hartleys people that came over, and a lot of them are really great, executives and other personnel as well that are highly personally invested in the business. So, yeah, while people will have their own P&L internally, I imagine there is a lot of drive to get shareholder returns.
Awesome. Lycopodium is another name you guys suggested, and it was pretty interesting digging into this. So I think it's a name that'll be familiar to a lot of people that follow the resources space. They build the projects, these sorts of things. So it was quite interesting digging into it. 90% weighted to the resources space with a bit of other sort of infrastructure work, and also quite a strong weighting to African projects. I think I saw 60% as well as gold. How do you think about the diversification of projects within the business there?
Yeah, Lycopodium's been a holding for probably close to 2 years for the fund. So we've initially, like again, it's not always the case, but had a very strong balance sheet. They have a real focus on not issuing shares and EPS. I think they've held 39 million shares for the last 15 years, and so
That's great.
Yeah, it's rare to see and really pleasing. That was quite attractive. When we spoke with Peter, the managing director, we spent a lot of time working through. There was a period, I think it was 2013, 2014, 2015, where there were a number of probably projects that they had successfully delivered that rolled off without that backlog of work to kick forward, and that's when you saw the profitability take a hit, and just understanding the evolution of the business from that period, probably close to 10 years ago to now. And I think the depth of the team, the spread of the team, so different parts of a mining project they would be focused in on. I think there was a big focus on getting expertise in many different commodities. So gold has been a key focus, but copper and also lithium, and two commodities where there's projects currently being delivered, a lot of studies they're doing delivering a really big project, which is a real step, a huge step forward is the Barracks project in Pakistan, Reko Dix. That's an enormous project that will take Lycopodium a number of years to deliver, and obviously will have a positive impact on earnings, is our view. But they've been able to diversify across multiple commodities. They've got a great team. The biggest bottleneck to growth has been finding staff, and that's been probably a feature of other engineering consultancies over the last 2 or 3 years. And when we spoke to the management, there was a real focus on we just have to make sure that we attract the right staff, and they weren't just on an expansion for the sake thereof. So very measured, very, very disciplined, and diversification and managing that risk. Part of that's due to the balance sheet, part of that's due to being able to deliver different projects and work at different components of a mining project. And also, I think their industrials business delivering projects for CSL. That was a project that they delivered in Melbourne. So there is a lot of diversification within the business, notwithstanding a key attraction to us is the outlook for particularly copper, and particularly their ability to deliver projects that probably require a high degree of technical expertise and being able to navigate some tougher jurisdictions that they've just shown time and time again they can deliver.
So one of the sort of challenges for a lot of similar type companies was finding people, like you mentioned. It was finding people to build the things or work on engineering projects, as well as in the offices as well, the white collar sort of jobs. Do you think most of that, at least in Australia, has kind of washed through, and they shouldn't have that sort of cost inflation that could be onerous on the margins of the business?
Yeah, look, it's absolutely a key question. I think we've been asking and listening to AGMs and the financial reporting on how easy is it to retain labour. We were catching up with actually a company recently that was talking about they just gave their staff an out of cycle, essentially a pay rise, and they had at the time a pretty heavy blue collar workforce, and they looked around and said, "This is fantastic. We weren't expecting this." And so there is that still pressure from wages. I think it's going to vary not just state by state within Australia, but also the disciplines. You'd probably start to find that it's going to be much easier to find staff in the white collar prior to blue collar. I think that's still, like if you are or someone in that industry, it's certainly one where there's a lot of work still, and actually finding people who have the ability and the resilience to work in tough environments is obviously getting harder and harder. So I think for workers that can do that deserve clearly to get paid. Companies are having to pay up. The white collar is softening. That's the feedback that we get at the moment, that's for sure.
To your comment on the cycle's not lasting forever, what are the signals that you'd look for that it's not quite working out, or, you know, that might be company specific, it might be across the whole space where we're talking about, but how do you sort of catch that before it kind of happens?
Oh, look, for different businesses will be different inputs. For one of our holdings that was acquired 2023 was DDH.
Yep.
And, you know, a key signal or leading indicator was ECM activity, or looking at what's the quantity of capital that's being raised by smaller companies to go out and then commit to exploration programs. So that would be probably one, but like I think at the moment we're seeing that largely, or hopefully, bottoming out at the moment, and we'll see an uptick of that junior miner capital raising activity. But that would be one kind of leading indicator for parts of the mining cycle. Utilisation, where you can get that data, is fantastic for different businesses that are probably more asset driven. Mining services, so when you can get data on utilisation, starting to see that turn. I think for us, while definitely is timing extremely important for mining services, just being prepared by managing risks wherever you can. I think from our perspective, having debt and seeing that as a key risk, and a lot of the big issues with mining services and when things can go south is when there's a very large debt load or gearing within a business. As a general rule, we will model out the debt and covenants, but when you see in an investor presentation, one or two or three slides where they have to go and explain this is our covenant ratio and this is where we sit and gearing, that's probably the first orange flag. And then from that, you then have to go and do your own modelling on to say, okay, I understand what the gearing ratio is. I understand interest coverage for this business, and that's a risk that I'm confident on if revenues drop 20, 30%.
Yeah.
But, where possible to find a business without debt is obviously key. Not to say that you don't see material drawdowns or balance sheets being impacted when you do see the cycle reverse. But it is something that we try to manage as best we can on the debt front.
And I think you've seen from the two examples that we are comfortable to invest in them because they have been good at managing the poor cycles for themselves. And then when it's the good part of the cycle, it kind of takes care of itself. But just as you need to have discipline when you're buying, and hopefully you're getting towards the bottom of the cycle for some of these names, you need to have discipline in selling. And when you're investing in cyclical businesses, it can be a bit more active in the way you invest, as opposed to more of a kind of a long-term compounder, kind of classic industrials company with steady growth. So you just need to recognise that when times are good, that's not going to last forever, and maybe it's time to manage some of your position. And just as when times are not so good, maybe that's a good time to be having a good look at it.
The last company I'm keen to chat about, and I'll disclose that I actually own a few of these ones, Vysarn. So, yeah, I'm pretty excited to talk about this business and get the perspective that you guys have. To start with, a couple acquisitions in the past quarter, one bigger than the other, but CMP and Wastewater Services. How did you kind of think about, that this is a company like we spoke about before that doesn't love to issue paper unless they kind of need to, and there's an appropriate opportunity. And I saw in your recent note that you guys chipped in, having invested a year or so ago. So how are you thinking about those acquisitions and the business in a broader sense?
Yeah. So we talk with James Clement, the MD of Vysarn, quite often, and I'll just start by saying he's probably one of the better managing directors that we've come across in small cap space, and so we've got a lot of confidence in what he's doing and then the team that he's been able to build underneath him. And they have some very strict criteria when it comes to acquisitions, and they also see this giant opportunity in water infrastructure on the East Coast, when they already are quite, well covered in WA. And so the acquisition of CMP has materially diversified their client set. I think they go from almost 100%, mining in WA to down to 70%, and that that 30% that comes from CMP is largely government and water agencies on the East Coast. There's going to be something like $60 billion spent on water-associated infrastructure in the East Coast over the next 5 to 10 years. And so James and his team made the really strategic and clever approach to CMP and have been able to absorb that into the business. So that adds a new division for them and a new geographical location. And then the wastewater services, also EPS accretive and also makes a lot of sense. It's still in WA, but it does provide them with a new division to their water service offering. And really what they're trying to do is be a vertically integrated water services provider across consulting, engineering, design, implementation. And of course, maybe you're about to ask about this, but they have this blue sky of this water asset management that's coming over the top. And so, yeah.
Yeah, keen to unpack that more and what that could sort of mean to the valuation of the business and the potential competitors that might come into the arena if that they seem to be the first mover in that one. But, these things in capitalism attract opponents. So how are you thinking about that?
Yeah, absolutely.
Business?
So, I mean, if you look at the current business and take the acquisitions into account, you've got the company business trading on, somewhere between a 15 to 20 times PE multiple, which given the growth and execution that they've been able to show, that's quite comfortable. It's not, you're not getting a super cheap, but it's quite comfortable. But then there's not really any value for the water asset management in that. And that aspect is hard to value for now until we really see some nuts and bolts put around it. But just for the listeners who aren't as au fait with Vysarn, what they've done is they've collected a bunch of water titles in WA, and they've done that in a really clever fashion and some of the most compelling water titles. They've also, and this is just fantastic what they've been able to do, is they've entered into joint ventures with traditional owners, and they will share the economics on a 50-50 basis. And so they've really ensconced themselves well in being able to be a strong operator and obviously get the good regulatory outcomes on the water services that they're providing. And what the grand plan is, in the vast spaces of WA, there is some areas that have a lot more water than is required and some areas which have a lot less than are required. And there's a lot of mining projects, infrastructure projects, agriculture, energy projects that require water that are currently, if not stranded, but, paying more than they would like to be or struggling for water. And so the idea for the team with the Vysarn water asset management business is to transport water from the, where they're able to find big aquifers on native title land to the places where it is required. And so that's going to require a huge amount of infrastructure in terms of pipelines and the like. And their idea is to partner externally for the funding and potentially management to some extent of that with more established and larger major infrastructure providers. And they've brought in Richard Lowry, who is an ex-investment banker but also water infrastructure kind of experienced guy, and he is leading that operation. And our understanding is there's going to be a lot more information on this coming out over the next kind of 3 to 6 months.
And what sort of timeline do you think about that business? Is that something that comes into effect? I'm sort of thinking 3-4 years. It could be. Obviously, it's a journey to get there, and things need to get built. But if you were to look at the blue sky, is that how you kind of think about it?
Yeah. What do you think from a timing perspective?
Yeah, I think 3 to 4 years is probably right before you start to see the projects really get going. In saying that, I think we probably start to get a better handle on the economics, so whether that starts with just the sizing of the water resource and how they would go about structuring or tolling, what's the toll fees, etc., over the coming 6 to 12 months. But that's our hope. And for us, as Will said, you've got really the core operating profitable business that's really underwriting a lot of our attraction to Vysarn. And so as we get a lot more information on the economics for the water asset management, it's just going to add to that.
And how do you think about the company moving away from, I mean, I guess against the other companies we've spoken about, the cyclicality of the business? It sort of started as a business that is pretty exposed now with the rigs to the mining cycle, but it seems to be on a journey to move itself away from that. Where do you see them on that journey right now?
Yeah, like a lot of other mining services companies, there is this big focus on diversifying away from mining, which sounds funny, but also WA to some extent. I mean, we're invested in another electrical services provider that was traditionally, as a Southern Cross Electrical, traditionally 100% mining, that are now, that's much less a part of what they're doing. And what they're really trying to do is de-risk that cyclical nature of mining. Mm-hmm. With Vysarn, I mean, we see this as a natural expansion, and they'll still get great benefit from mining, but to grow and be able to expand and be able to kind of smooth out some of their growth trajectory by being on the East Coast, that's really positive from our perspective. Of course, this water asset management is going to be highly leveraged to mining, so they may actually kind of increase their exposure as they go through, but that should be more of an infrastructure style, kind of steady income style risk. So I mean, it is multi-tinged. They got the cyclical mining, the more steady kind of water consulting to governments and the like, which they're building out, and then hopefully an infrastructure style play. So altogether it should make for some quite rich risk return.
Yeah, I think at the moment they're probably 70, 80, 90% would be, outside in guessing percent the way through the diversification that they want to achieve. I think FY24, there was still, I think they had some rigs in a nickel project that they had to, push elsewhere within the portfolio. So I think there has been some of that of recent times drag, but with the acquisition and particularly of the East Coast consulting business, we see them as really well and truly on the way to getting that diversification and giving themselves some immunity to that harsh cyclicality of the mining of mining services.
So we've talked around the mining industry for quite some time, but you guys are pretty tapped into the capital raising cycle, in particular with the juniors, and it's been pretty active. Even today, I saw a good few coming through, and I saw in your quarterly you mentioned you're looking at 3 to 6 opportunities a day, which I'm sure keeps you kind of busy. How do you look at these opportunities? I'd imagine you're familiar with most of the companies beforehand. Is it a quick answer once you know the sort of, do you see the term sheet, the details, or what's that process like?
Yeah, so you have to be able to say no quickly and a lot, because of just the huge amount of opportunities that come through. But I mean, we're talking about cycles a lot, but capital raisings in mining companies come in quite sharp waves. And so where there's been probably a year or two of quite subdued kind of activity in that space, we have seen a ramp up in the last 2 months. Not to say we haven't seen ramp ups over that last 2 year period. So we're still just working out how sustainable it is at this point in time. But what you do see at the start of the wave of a kind of a cap raising cycle for junior mining is the more quality names are coming to market first, or you're getting better terms on the things that do get to market. And so it is really important to make sure you're on top of that and really able to participate, if you've got the spare capacity and if you've got a good understanding of the fundamentals of particular companies. But what happens is that then builds, the aftermarkets get better, the FOMO trade starts to kick in, and then you start to see worse terms on the equity raisings and probably poorer companies being able to get to market. And that's where you really need to keep your wits about you and say no even more than you had been before.
The sort of timing there is super fascinating. How do you think also, as it ties in with positioning yourself in a company? I know there's certain funds, obviously it's very size dependent, but they will wait for the raisings because it gives them an opportunity as opposed to being on the market and buying day after day. Does that play into your thinking a lot?
It definitely does. I mean, mining companies are always raising equity. I mean, and you just have to be aware of that if you're investing in mining. I mean, if they're an explorer, they don't have any revenue and they need to raise equity in order to explore, and it's very hard and probably not recommended to take on any debt at that point in time. For developers, maybe they've got a more established project, maybe they're able to raise more money, but it is almost always like still quite a high proportion of equity. And then, you look at St Barbara today raising $100 million, they're a producer and, they need to raise equity as well. And that can be expansion CapEx, it can be covenant issues, it can be acquiring another company. So there's always lots of reasons for miners to raise equity. In order for us to enter a position, one of the first things we'll look at is the cash balance and the cash burn. And so we need to see how much of a runway this company has before it does need to raise equity. And if that's an uncomfortable runway, then it doesn't matter how much we love the commodity, the project, the team, et cetera, you're probably going to be more so waiting for the equity raising to come around. And then what you've got to take the view on is that management team is a type of management team that can add value with that capital so that the next time they need to raise equity, it's at a higher price and you're not seeing dilution for shareholders.
And will you guys ever encourage a company that you've already invested in to, go to the market, now, this week you'd say for gold companies, it's a good time that there seems to be demand. Obviously, every case is kind of different, but how do you think about that?
There's certainly an element of if the going's good, grab some capital while you can, because those that hold out, for high prices or catalysts or what have you, things can go against them and maybe you get more dilution than you were expecting or hoping for, or maybe have to hold on for longer and not able to do all the capital works that you were after. So we certainly ask a lot of questions and get involved with companies with respect to their capital requirements. And, coming from a mining finance background, we do have some understanding of that, and so hopefully can provide some, informative discussions with mining companies on that. We absolutely keep in touch with companies on it and, try to lend a hand when we can.
Couple last ones to wrap up, guys. What are you most excited about looking out the market right now?
I think the money miners will be happy to hear that it is junior mining. We're really excited about junior
Thrilled
mining.
to hear it.
Yeah, exactly. So, we're seeing some green shoots in gold, silver, antimony. I had to look up how to pronounce that today, I have to admit. But what we've really seen is a long time in the wilderness for a lot of these junior mining companies. We know where we need to get to with a bunch of these commodities from a demand supply perspective. There's lots of interesting projects out there. Something's got to give, and we will have a really good time in junior mining. Hopefully in the not too distant future. I can't say exactly when that will be, but we're certainly very excited by that. We're exposed to it, and we're always there watching.
Yeah, knock on wood. And lastly, any sort of contrarian picks you've got going against the grain a bit?
Yeah, we thought we'd go with mining on this front as well. So rare earths, such a tough one, right? You've got all the different mineralization types. You've got the market seemingly changing its views on which mineralization style will win, on a weekly basis. But there's one that we like called Viridis Mining. So they're a Brazilian rare earths, hopeful developer, hopeful producer. They're in the same region as Meteoric. So they've got the Caldera project. Viridis has the Colossus project. As far as we can see, the Viridis project is rather analogous to Meteoric's project. Viridis has got a slightly smaller resource at this point in time with 200 odd million tonnes at a similar grade, which is around that 2,600 parts per million TREO. And then they've actually got quite a high proportion of magnetic rare earths at about 26%. So you compare those two side by side, Meteoric probably, anywhere between 3 to 12 months ahead. Some would argue longer than that. Some would argue shorter. They've released a scoping study. they're a 220 mil market cap, and you've got Veritas at a 35 mil market cap. So it's something like Meteoric is trading at 7 times what Veritas is. So there's a bit of buffer there that we think is quite interesting, just in terms of how similar their projects are. But also we recognise the risks. People are worried about the processing of these ionic clays that hasn't been done at scale, in this area, and so there's always going to be risks in the ramp up. The metallurgy, while they have done a lot of testing on that, it still hasn't been done at great scale. And then Brazil is still somewhat of an uncertain jurisdiction for some, but on the flip side of that, at the current market cap with the resource that they have and a great management team in place and pretty strong capital markets following, we actually see Brazil as quite a positive jurisdiction. Their permitting is almost world leading now in terms of electrification minerals. You saw what happened with Sigma.
Yeah, Pilbara brought in.
Exactly. Latin Resources were really confident on how quick their permitting is going to be. There's been some focus on Meteoric and Veritas with the respect to permitting. These are huge resources. They're high grade by clay and ionic clay standards, and we believe just the kind of the risk is in the favour of this company at this point in time, and that just to give you a soundbite, we believe this could be the Pilbara of rare earths, where they are in Brazil. Not saying it's definitely going to happen, but as far as having a pun on rare earths goes, we believe Veritas is a really good exposure.
Yeah, awesome. The clays are a fascinating one to watch, and the rare earths market is so complex and opaque, but fascinating at the same time. Will and Brayden, thanks for making the time. It's been awesome to chat and learn about Baza. Thank you.
Yeah, cheers, JD. Thanks for having us, mate.
Thank you, Jonas Benedict Dorling and the bloody lads from Baza Capital.
That was sensational.
Bloody, that's a good name.
Baza.
Baza.
It is such an Aussie-sounding fund manager name, isn't it? I don't think you could get a European or an American Baza, right?
I'm going to start Sharon Capital.
Sharon.
I got some more names I like, guys. Mineral Mining Services, Grounded, CrossBoundary Energy, Sandvik Ground Support, CRE Insurance, K-Drill, Stat. Go Australia.
Go Australia.
Go Australia.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.